Hey guys, hope everybody's doing well today. I'm back with another QYLD video. I got a comment about whether these dividends are qualified or not. And we're going to go into that. And if you missed my last video, I did kind of a deep dive on QYLD. It is a Nasdaq 100 covered call ETF. So the Nasdaq 100, if you don't know, is heavy tech stocks. If you're familiar with the ETF QQQ, look up the QQQ. This is based on that. Well, they're both based on the Nasdaq 100, but they have two different strategies. The QQQ holds the stocks and you participate in the long-term growth. So if you'll notice on QQQ, I don't even think you have a 1% dividend yield out of QQQ. QYLD holds the same index, but they sell covered call options for current income on those stocks. So what will happen is you will not get the growth of QQQ in QYLD, but you will get an 11.5% distribution off of the NASDAQ 100. But you will not get the growth that the QQQ offers. So QQQ is buy now and growth later. The QYLD is buy now, income now. I hope that makes sense. So you kind of have to balance what you want to do. In my opinion, this is QYLD is more for people that are in income status where they need to live off their portfolio, live off their money, and they can get a very decent distribution from QYLD, which they would have to sell shares of QQQ to generate the same income. Here, you just get your distribution. So if you're new to the channel, please like and subscribe. I'd appreciate it. We've been growing quite a bit, and I really, really appreciate it. Leave me a comment down below. Let me know you're new, and I conversate and interact with everybody here, so I would appreciate it, and welcome aboard. So as far as the dividends are concerned with QYLD, I went looking a little deeper after I got the comment, and I went on here to portfolio composition. I'm here on Fidelity. And I didn't see anything out of the ordinary because I clicked on distributions and expenses. And you'll see right there, look at that, distribution yield of 11.73%. And it pays a monthly distribution. So that's almost a 1% distribution per month. That is nothing to sneeze at. And if you look, they're 12-month, trailing 12-month total amount dividend, $2.35. So average is just under 20 cents per month. It varies month to month, but as far as qualified dividends, I thought, well, it's dividend income. It's from an ETF, so I decided to go a little deeper, and I went onto the Global X site because I look on here and you can see ETFs can classify your ETFs, any kind of funds can classify your distribution in several ways. They can classify it as long-term capital gain, short-term capital gain, dividend income, or return of capital. Now, return of capital is considered to be the least favored form of a distribution. but it doesn't have to be. And if you guessed it already, because I'm pointing this out, QYLD mostly distributes return of capital. And when you see that word, the thing that comes to your head is return of whose capital? Well, it's essentially the return of your capital, your money invested coming back to you. Now, the first thought when I first hear that is like, well, why would it? That's stupid. Well, that's just the way they classify the distribution. And there is advantages to that. So I went on their website and I looked at their most current distribution, and sure enough, 99.24% of the current distribution is return of capital. So what is return of capital, you might ask? And how does that affect me? Well, I can it's probably easiest that I use this little key assumptions here on ETF trends. And we'll go through the key assumptions. I'll try not to make this very long, but we'll go through the bullet points at least. So, an investor's unrealized capital gains in an ETF are not taxed until an investor liquidates his position, or if not liquidated, can be eliminated due to step-up provisions of the federal estate tax. So if you hold this forever and you pass it down to your kids, they won't pay taxes on it either. Here's returns of capital are paid out of shareholder equity, your money, which is the equivalent of an ETF's net asset value. Returns of capital are not taxed. So they cannot tax a return of capital because it's already your money. So if it's classified as a return of capital, even though it may technically not be, you are not taxed on the money. So with the exception of qualified dividend income, which is taxed at a reduced rate, traditional dividends and bond interest distributed by an ETF are taxed at an investor's ordinary income tax rate. So this is not applicable to this ETF, which is QYLD. Capital dividends, which is, I don't know why they did that, but this is return of capital dividends, are paid out of an ETF's net asset value, and while not taxable, reduce an investor's cost basis in an investment. Now, this is important. So let's say the fund is $20 a share. We're going to just do round numbers. And they pay out $2 per year in a distribution classified as return of capital. So if you bought that share at $20 and they return $2 in a distribution to you and classified it as return of capital, your cost basis of that original $20 share is now reduced by the distribution of $2. So now that share that you pay $20 for, your cost basis is now $18. Does that make sense? If that's confusing, let me know and I'll try to explain it a little better. So lowering an investor's cost basis in an ETF increases the capital gain on the shares when the shares are sold. So if you never sell and they continue to classify the distribution as return of capital, you will never pay tax on this, ever. Now, they do have discretion, though, to reclassify the distribution as something else. So that's something to think about. So if you hold this ETF long enough, and how do I explain this correctly? If you hold this ETF long enough and they return distributions to you classified as return of capital long enough, your cost basis for these shares can keep going down even negatively. You can get to zero. You can get to a zero cost basis in these shares, and every bit, you're going to have 100% yield on cost at that point, because return of capital reduces your cost basis. So, and then you'll never pay taxes on it unless you sell. Now, if you sold the shares and your cost basis is zero and the shares are selling for 20, you will pay the long-term capital gain from your zero cost basis to $20 per share. Does that make sense? Because that's your gain, because you have been returned all your money over the years. I hope that makes sense. If that's confusing, let me know, and I'll see if I can find some ways to make that a little bit more clear. But so if you were to sell, though, the tax rate for long-term capital gains is lower than the tax rate on ordinary income. So, it's, and if you're in a tax bracket, if you're retired and you don't have income of, well, these numbers are probably changed because this is from 2018. I don't know what the exact numbers is, but you could possibly pay zero completely if your income is low enough. I know there's been changes in these brackets, so I'm not going to use that. So, I'm not a tax advisor. I'm not a financial advisor. I'm not a stock advisor. I'm just some dude on YouTube learning this stuff and sharing it with you. If you have any other questions, let me know. But if you decide to buy this, please consult with a professional that is probably not going to be on YouTube putting up funny bitmojis and whatnot. So I hope you enjoy. If you haven't looked at the QYLD ETF review, that was my last video. Check that out. My next video coming up is on Saturday, and I'm going to be pitting this ETF to a paper portfolio of $250,000, and it's going to be a paper portfolio, and I just want to track my my strategy of generating income in retirement using covered calls on stocks I already own versus just dumping the money into QYLD. We'll track that. I don't know how long we'll track that. We might track that for years, because I need to know which route I go once I hit retirement. So if you enjoyed, please like, share, subscribe. I'd appreciate it. Leave me a comment down below. Wish you all the best. We'll talk to you later. Thanks. Bye-bye.